All right. So where do we get started? Um, you can simply start on the inputs tab and start just filling out all the information. Like I said, that the text that you see here in dark blue is data that you input. Everything that's in black is either a calculation or a title. So, you can start here at the top, filling in, the property information, all the way down, seller information, the value add details, income and expense assumptions, and so on. And quite frequently, you can enter in all the information onto this inputs tab, and it will calculate everything for you. The goal with the back of the envelope underwriting template here is to evaluate a property within 10 to 30 minutes. That's really how long it should take you to evaluate a deal. And the purpose of the back of the envelope is to decide, is this a deal that we want to move forward on with submitting an offer? And do we need to dive deeper into our analysis? So that's really the goal of the back of the envelope. Now, there is a full underwriting model that we also use within CPI Capital. And it can take a couple days just to gather all the information and put it all together to properly and professionally underwrite a deal. But like I said, the purpose of the back of the envelope is so that you can evaluate a deal within 10 to 30 minutes. So you don't necessarily need to enter in the entire rent roll or the T12. And the reason I do this is because I like to get a little bit more granular on the data, right? So I'm a geek in the sheets. I love spreadsheets and I love data. I love looking at how is this property performing, and to really understand how this property is performing, and maybe to uncover opportunities. I usually like to dig into the rent roll in the T12. But again, you don't necessarily need to enter that in this tab or this tab. You can fill out everything on this sheet here to get your ultimate valuation. So now, the information that you enter into the rent roll in the T12 is pulled into this spreadsheet. So, for example, this calculation, average in-place rents, is coming from the rent roll tab. You can see that right here, RR for rent roll. Average square foot, it's also pulling in from the rent roll. You can ignore these calculations and then just simply add in a number that is straight off of the broker offering memorandum. So there are several instances where that is true. So you could enter in that information straight on here. And maybe what I'll do is I'll assign this actually as a different color so that it's an option. Do you want to enter it in now, or do you want it to basically pull that information in from the rent roll and the T12? So I'll leave that up to you. But again, I like to go ahead and enter all the information in from the rent roll and the T12 so I can get a deeper dive into looking for opportunities, right? So you can simply start here at the top, so the property name. What I do then is, this is the broker offering memorandum, the OM, for a property called Villas of Flagler Point. Located in St. Petersburg. It's 136 unit, built in 1936. 1972. It's 136 units built in 1972. What's great about using the broker OM is they've already done the homework for you. They've kind of already outlined what are the opportunities, what is the business plan, and what you should look at. So the offering memorandum is a great place to start with, all the information. And the information that you need on this inputs tab should be included, if the broker did a good job, should be included in the offering memorandum. So, for example, what the upside is for operations, other income How much are you expected to get from other income? Let's see, what else do they say within here, where it's located. More details about the property. Other fees that the property is currently collecting, like valet trash, pet rent, pet fees, pest control. So these are all additional income items that you can enter into your underwriting. This is a breakout of the unit mixes and the average square feet, 787. Average in-place rents, according to the offering memorandum, is at $1,293. And where they feel there's a financial section later on that they kind of give a pro forma of what they feel that this property is going to. So other additional charges, washer dryer upside. So again, this is a good representation of a business plan that you could actually use for your analysis. So here's their unit mix breakdown and what their pro forma rents are, pro forma gross possible. And so then they've got the T12 information in right here. And then they've got the year over year projections for the income and expenses down here. So again, you can literally take all this information and just start plugging in to your inputs tab here. So let's go ahead and just start filling out some of this information just so you can see how this works. So let's just go ahead and call it Villas at Flagler Point. Okay. And it automatically has apartments right next to it. As far as the location and entering in the full address, I like to enter in the full address into one line, so that way it's quick and easy for me to do Google searches with and looking up assessor websites so that I can determine what the taxes are. So 2150 62nd Terrace South and St. Petersburg, Florida 33712. Submarket, this is South St. Pete. Now the submarket, meaning that CoStar has their own definitions of submarkets. You may be familiar with whatever submarket your property is located in. This is just to kind of differentiate where the property is really located within a certain market. So St. Pete is a submarket really of the Tampa MSA. So and the true submarket, according to CoStar, is South Pinellas because this property is located in Pinellas County, and so the submarket is South Pinellas. Total number of units, it's 136, built in 1972. Now you can see that there's some information that's starting to populate here. Now, like I said, this information is pulling straight off of the rent roll, but if you don't want to enter in that rent roll, that's totally fine. So you could start entering in the average in place rents. So 1376, is the average in place rents that I know about for this property. And now you can see the year one pro forma here with the 3% growth. You're at an average base rent of 1417. So if this was a 0% growth, its base rent is now at 1376, which is what's currently in place. Again, if you do that for the next year, 1376. So you could play around with these numbers and just see how the model behaves and how it performs. And I recommend that you do that. Test it out. Play with it. Because it is important to understand, what small triggers can really affect your underwriting model. So the more you play with it, the more you understand how this behaves. And And when you look at other syndicators and how they may evaluate deals or put together their pitch deck saying that, oh, this submarket is going to have a 5% rent growth. Well, let's look at the difference, between a 5% rent growth, the returns on that, versus a 3% rent growth. So it helps you kind of understand like these different levers that you could pull and the changes that it makes to your underwriting model. And so the more you understand that, the more you're going to be able to feel comfortable with, at least the conservative level of underwriting, and where you might have some, call it sandbags. That's what I call it. Where do you have some pockets or buckets that you might be able to fill in any voids. Okay, so average square foot, again, that's pulling off the rent roll, but this is 787 is the average square foot. And so you can see it's starting to calculate the average rent per square foot here. Okay, seller information. So the seller information, you could usually get this off of a CoStar report. So here's an example of the CoStar report for villas at Flagler Point. And so right here, Mainline Investment Partners purchased this in June 2016 for $7.7 million. All right, 7.75. So we could go ahead and say Mainline Investments. They bought it for 7.75. Whoops. 775. Okay. June 2016. Okay. And the whisper price. The whisper price is the guidance that the broker gives you for what they feel this property is worth. So, for this property, for example, the broker initially said that their guidance and what they were trying to get for this property was around $22 million. So that works out to be $161,000 a unit. Now that's a little on the high side, in my opinion, for this property in this market. And so what's nice is the more that you underwrite these deals, the more that you're going to see, a trend of what is a good price per unit. Okay, so these are some of the metrics that you start to pick up on, and numbers that become really important to you. As far as value add, average rent increase, again, you can pull this straight off of the broker offering memorandum. Units to be renovated. Let's do 100 units. Renovation timeline. So one way for me to figure this out is I look at the rent roll and the lease expiration schedule. And in fact, I have this built into this underwriting template here. This is the analysis of the number of leases expiring per month. And so what this does is at the bottom of this spreadsheet, it will total it all up and it will show you like how many leases are expiring each month. And this is important to know because if you have during your slow period, you have 6 units or 6 leases that are going to be expiring. Let's assume that 50% of those tenants leave and 50% stay. So that leaves basically 3 units for you to renovate each month. And so if we're going to be having a renovation velocity of 3 units a month times 12 months, that's 36 units a year. It's going to take us about 3 years to basically renovate this property. So we'll leave that at 3 years. Interior upgrades and exterior upgrades. Again, this is information that you could either get straight from the broker if you don't know, or contractors or property managers. So it's this is definitely a number that you're going to get more and more familiar with. And this number changes. It changes based on the quality of finish, the market demographics, the what the current finishes look like. If it's a heavy value add, like a property that hasn't been renovated and all the units are in classic condition, you could be spending anywhere between $12,000 and $20,000 a unit. Otherwise, like if something has been recently renovated, but you can add more modern finishes. That could be somewhere between 3 and 5,000 a unit. So it really depends on, conversations with the broker, walking the property with your contractor, and getting a better idea. So for now, let's just leave it at 9,000 a unit. This is kind of middle ground. And same with the exterior upgrades, 2,000 a unit. So the 2,000 a unit, should cover things like, landscaping improvements, exterior painting, so on and so forth. And if you really look at it, it's only $272,000, and it's not a lot. So my rule of thumb is you should be somewhere initially around 10% of the purchase price for your CapEx budget. If we're going with that purchase price of, near 22,000, 10% of that's, $2,200,000. That might be on the little high side, but we'll cover that. This is something to still kind of keep an eye on, and have conversations there with your broker. Other income. So miscellaneous income, fee income, and total utility income. So again, you could pull this straight off of the broker offering memorandum from their financial section. So if I jump back to wherever that was in their financing, financial analysis, here we go. Other income, we've got total other income totaling up to basically $1,800 per unit. And then this is their pro forma going to $2,400 per unit. So, let's just say all this included, it's currently at $1,800 per unit, right? And so now you can start to see these numbers start to populate here by the miscellaneous income. As far as these expenses, again, like what I was saying in the previous section of this video was, I've collected, information about expenses and expense ratios and expenses per unit throughout the state of Florida, and separated it out based on the market. So like the submarkets. So we've got the Central Gulf Coast and the Southwest, Central, North Florida, expense per vintage, per unit count. So anything that's less than 100 units or greater than 300 units. And then I've summarized it down here. So Villas of Flagler Point, 136 units, built in 1972. Again, this information is basically pulled straight off of the inputs tab, so you can see it. And you might have to copy and paste, or see the unit count and make sure that the right unit count is in here. So right now it's showing 100 units or less, so that's incorrect. So it's between 100 and 200, so it's 7,100 per unit per year is what the expenses should be around. All right, so I got an average of it all for the location, the unit count, and the vintage, and this takes an average. So, we're looking at somewhere between 8,000 and 7,000 and 8,000 a unit per year for your overall expenses. So we can start here at the top: repairs and maintenance at 407, contract services at 394, turnover costs at 257. All right, so you could take something similar to this for your market and start entering in this information. So 407, you can see this is pulling straight off of that expense per unit cost. So 407, 394, 257. So again, these are typical expenses for this market. But what's really important is for you to actually look at the trailing 12 performance to start comparing it. So this is what this column is going to be. What it's doing is right now it is totaling from what's shown here. But these here, you can see that these are blue, but it's coming from the T12. So again, you can enter in the T12 information. I'm going to show you how to do that on this underwriting template. And you can simply just add in, repairs and maintenance from the last 12 months based on this. So let's go to repairs and maintenance over the last 12 months. Based on the T12, they're at 321 per unit. So 321 per unit. And then that's when you would enter that in, 321 per unit. Okay. Oh, sorry, this is total amount, because that you can see here, this only came to $2 a unit. So that's why it's always good to double check. So so that came to 43,653. 43,653. There you go. 321 a unit. So now you can see the difference. 321 or 401. Okay, well, we're being a little bit more conservative if this is the case. If we're going to use that number. So again, you continue to fill out all this information, or using the T12 inputs tab, which I'm going to show you later on in this video. So you keep on entering in this data, and same with up here. You can start entering in all the data up here from the offering memorandum. So again, turnover expenses 39,528. What was that again? Turnover 39,000. Okay, so they're at 287 versus 257. So pretty close to market. Okay. All right, so you keep filling that in. And again, now you should start looking at your organic expense growth. So, that's usually somewhere between 1.5% and 3.5%, depending on the market, depending on what's going on in the economy, inflation, all that stuff. And so, if you want some guidance, talk to the broker. They might actually have in here a description of how they're evaluating their rent growth. I don't see it right off the top here, but sometimes they do have some more descriptions of what they're using for their rent growth, their assumptions, etc. So go back to here. So you could start entering in, say, like 1.5 in the first year, 2.5, 2 in the next year, and then 3 every year after that. Okay, so that's what you could use there. And then as far as economic loss, I didn't cover this yet. Economic loss, that includes your vacancy, concessions, bad debt, and then renovation vacancy. And also like a model unit or down units. So you kind of factor all that in, and you could also look at the current market vacancy and then buffer that out a little bit. But a good rule of thumb is just starting with 10. 10% economic loss is a good way to kind of build some buffer in there, sandbag it, as I say. And that way, if you really needed to, you can really fine tune this number as well. Okay. All right. So you continue to enter in that information and comparing it to basically your expenses here. And then when you come down to the sources and uses of cash, so this is where you kind of change your purchase price to get the returns that you're looking for. So the returns are going to be shown right down here. So right now, based on just the information that I've entered, the levered IRR is just under 15%. Not too bad. And this is project level. It doesn't break down the investor level yet. I don't have an investor waterfall built within the back of the envelope. So this is just project level, project returns. And if you want to dive deeper into the limited partner economics or investor economics, you're going to need to use a model that really breaks that down and their different waterfalls, which is what we use in our full underwriting model as well. So let's see. So as far as you could change your change your purchase price to get whatever returns. A cool little trick that I use is my what if analysis. So say like my goal, my offers are based off of making sure that I get at least a 20% IRR on my property. So if I go to click on that cell, so it highlights that, go to what if, I want to go to goal seek, okay, and I want to set this to 0.2 for 20% by changing the purchase price. Okay, so you hit enter. Okay, and so bam, it just calculated. So it gave me now a 20% IRR on a purchase price of $14.3 million. Okay, that's $105,000 per unit, or 65% of asking price. Quite a discount. And so that's a good place to start. But again, I haven't entered in all my information yet. So there's more data that we need to enter. But that's how basically I do that. Then you could break out your GP and LP equity and where that money is going to be coming from. So far it looks like we need around 16 million of all cash, including our loan, our equity from the GP and LP. So that brings us down to basically the debt assumptions. So this is where you have a conversation with your lender and seeing what debt sizing may be for this particular property. So 70% loan to value. You're going to have a 1% loan fee. CapEx finance. This is if you're using any type of bridge debt or anything like that. You're plugging in your interest rate, your amortization rate, and how many interest only years are you using. So let's just say 2 years of interest only. Okay, and then that should have changed. Yep, it did increase the IRR by having an IO period of 2 years. And as far as the loan sizing down here, so you could say I want to underwrite this to basically a cap rate of 6, or let's just say the market is 5.5%. That's going to determine what is the value of this property based on 5.5%, and so you're at a discount based on the market value. Excuse me. It's going to propose a certain loan amount based on how you're sizing up. It's basically taking the minimum of all these different coverages. So you got your DSCR, your debt service coverage ratio. Usually it's around 1.25. Sometimes I've seen it at 1.5. Debt service coverage ratio for interest only, which is usually lower in that case. Debt yield of 8% is marketable. Loan to value, maximum loan to value is 80%, or a maximum loan to cost at 65%. So you could change these metrics right here in blue. So let's just say that it is a 70% LTV, or just so you could see 65% LTV, and it's coming out to basically a proposed loan amount of 15 million, but the loan to cost at 10 million is what it's saying here for the proposed loan. Based on your debt assumptions up here, the loan proceeds are at 9. If I was to take this full leverage up to 90%, it highlights, hey, you've got an issue here. There's an error or a concern that this model has. So the loan proceeds at 90% would be 12 million, but the lowest you could go is at 10.5, or not the lowest, but the highest you could go. Sorry, the highest you could go is 10.5. And so there's an issue there. Okay, so you can play around with these and just see how everything kind of behaves and works for you. So that's the inputs tab. I'm gonna go over how I enter in the rent roll and the T12 next.